the investors or traders, if you will, think the market's going up from 4,000. It's consolidating at 4,000, but going up. And as I've indicated to you before, I think this secular bull is in place and probably will peak out around 6,000 an ounce.
I still own gold and silver, and I hope I'm smart enough to buy more if they go down. Well, I guess for silver, it's a long-term triple top, first went to
Right.
50 back in 1980, etc.
In this sharp market breakdown, Jim Rogers and Steve Hanke share their perspective on why gold's current consolidation around the $4,000 level is anything but bearish. They explain that traders see this pause as a setup for the next major move higher, not a sign of exhaustion. Their outlook suggests that the ongoing secular bull market in gold remains intact, with the potential to ultimately peak near $6,000 per ounce as physical demand strengthens and global currency pressures intensify. They also turn their attention to silver, noting its long-term pattern of repeatedly testing the $50 region, a structure many refer to as a triple top. But rather than signaling resistance, Rogers and Hanke argue this historical trend may be laying the groundwork for a powerful breakout as monetary uncertainty escalates and investor interest continues to rise. Both analysts emphasize the importance of maintaining core holdings in gold and silver, using market pullbacks as opportunities for strategic accumulation. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
The federal funds rate is an overnight rate, and the 10-year, the duration is, literally 10 years longer than the Fed funds duration. And the Fed funds is controlled by the Fed. The 10-year is not controlled directly by the Fed. The market determines where the Fed fund, where the 10-year is going to be. And as you implied, the 10 years not quite buying into the fact that they've reduced now the Fed funds rate considerably, and will probably reduce it some more in the December meeting of the Open Market Committee. But interest rates are tricky because people don't understand that the so-called Fisher effect is that the short-term rate controlled by the Fed moves in one direction. It goes down, and everybody says, "Oh, rates are going down." But the next thing that happens, if that rate going down implies that the monetary policy is going to be looser, that means that with a lag, inflation will seep into the system. More inflation will come into the system. And that means then the longer duration bonds the interest rates will go up, the prices will go down. So they move in opposite directions, actually. But the timing is different. There's a lag between the time that the Fed funds rate are actually changed and the longer term bonds their yields are altered. We had the longest bull run in bonds probably in history, and the bull is we've pivoted into the bull market has come to an end. The longest bull market probably in the history of bonds did come to an end, and you can see it clearly on that chart. That's what the chart is telling us, and it was a great bull run. I mean, we basically went from early 1980s until your chart doesn't even go back that far at the start of the bull, but it started in the early 80s and just ended, in the last couple of years. Oh, all these standard measures for bubbles are just baloney. You've got to price it in terms of gold, and if you do, it's not as bubbly as you might think it was. That's about the only interpretation. But all the standard measures, the bubble measures, make it very clear that we're definitely in a bubble.
In this in-depth economic breakdown, renowned analysts Steve Hanke and Jim Rogers shed light on the major shifts now unfolding across U.S. interest rates, long-term bond markets, and the broader monetary system. They explain why most investors misunderstand the crucial difference between the Fed-controlled federal funds rate and the market-driven 10-year Treasury yield, and why the current divergence between the two could signal far larger structural changes ahead. As they outline, when the Federal Reserve cuts short-term rates, it often triggers expectations of easier monetary policy. But rather than pushing long-term rates down, this easing eventually fuels higher inflation, which then forces yields on longer duration bonds upward. This delayed reaction, known as the Fisher effect, is essential for understanding why bond prices and inflation expectations often move in opposite directions. They also highlight that the U.S. has officially exited what was likely the longest bond bull market in history, a cycle that began in the early 1980s and finally broke in recent years. The charts now suggest a definitive end to that multi-decade trend, raising the stakes for investors who still assume falling rates are guaranteed. Adding deeper context, the speakers emphasize that traditional bubble metrics have become misleading. When asset valuations are measured against gold, rather than inflated fiat currencies, the so-called bubble narrative looks far less extreme, revealing how distorted conventional financial indicators have become. This discussion offers a clear blueprint for understanding rate cycles, bond market transitions, and inflation dynamics during a pivotal moment for global markets. Let's get into the interview.
Well, I guess for silver, it's a long-term triple top. First went to
Right.
50 back in 1980, etc. It's now making new highs. I'm not selling my silver. If it goes down, I hope I'm smart enough to buy more. I mean, Danny, I'll repeat, I want my children to own my gold and silver someday. Unless, if the world comes to an end, I'll have to liquefy my gold and silver. But I hope that doesn't happen in my lifetime. I do own gold, I do own silver. But as I say, I've sold nearly all my shares around the world because, for one of the few times in my life, nearly every market is making all-time highs. Danny, that has rarely happened. And in my experience, when everybody's having a good time, it's time to look out the window and say, wait a minute, something's wrong. Something's going to go wrong. Not wrong right now, but everybody's happy.
I would characterize it as having a small to modest effect. It did have over what was happening to the economy. If it would have lasted much longer, it would have obviously had the magnitude of the effect would have been a lot greater. But we don't really know exactly even the short-term effects that it had because we don't have the data. So was it a negative in the market or not? Well, probably, if anything, a negative. But the key thing with the market is that the market's in a bubble. If you look at the cyclically adjusted PE, the CAPE measure of Robert Shiller, that's definitely in a bubble. Second highest level it's ever reached. If you look at the Buffett measure for U.S. market cap versus GDP, that is in an all-time high. If you look at my Dr. X's bubble detector, it's at an all-time high. So the market's in a bubble.
In this closing segment, Jim Rogers and Steve Hanke offer a sobering perspective on where global markets stand today and why caution may now be more valuable than complacency. One of the most striking insights is the long-term formation emerging in silver. After decades of testing the same major ceiling near $50, silver has finally broken into new territory. Rogers emphasizes that he has no intention of selling physical metal, insisting that long-term holders should remain focused on generational value rather than short-term market noise. At the same time, both analysts highlight something far more troubling. Nearly every major asset class is positioned at or near all-time highs. Historically, such rare, broad-based euphoria often signals the point where risks accumulate quietly beneath the surface. Markets don't usually peak when investors are fearful, but when they are universally comfortable. Hanke reinforces this with multiple bubble indicators, from the cyclically adjusted PE ratio to market cap to GDP comparisons, all flashing extreme readings. These aren't small distortions. They are signs of a financial landscape stretched well beyond historical norms. As the discussion makes clear, precious metals remain one of the few areas still grounded in real value, while broader markets drift deeper into speculative territory. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.